Good afternoon, everyone. I'm Nicole from the Institute of Banking and Finance. Thank you for joining us this afternoon for this IBF Masterclass, jointly organized with the Institute of Mergers, Acquisitions, and Alliances on digital takes like FinTech in Southeast Asia. We're glad to have with us today Professor Christopher Kumar, President of IMAA and a Professor for Strategy and Finance, along with Rohit Singh, who's an active VC and PE investor, to share more on the immense fintech opportunities in the region. We also have with us Alexander Bari, Managing Director at IMAA Institute, and Feryani, Sales Manager at IMAA, who will share more on their courses later on. Before I get the team to share on their insights, allow me to do a very brief intro on the IBF and the resources we have to help professionals in the financial industry. IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has evolved into one of standard setting for financial services sector skills and competencies. In August 2018, our mandate was expanded to cover career advisory and job matching functions for the financial services sector. We were also appointed as a jobs development partner for the financial services sector last year by the Jobs Development Council, and now oversee both skills and jobs development in the financial industry in Singapore. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more about our services and connect with us on any of these areas via our website. The enhanced course fee subsidies, which are part of MAS's support package to encourage companies to send their employees for training and upskilling, are shown as above. Training costs under IBF recognized programs will be 80% for trainees below the age of 40, while remaining at 90% for trainees above the age of 40, and will continue to be in place until 30th of June, which is tomorrow. We will be updating our training support measures for July. You can find more details on the enhanced training support on our website later next week. You can also find the list of eligible training programs on the IBF Program Finder on our website. In addition, IBF will also be supplementing the commercial training available with free webinars during this period to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at their own leisure. All these are complimentary and accorded with CPD hours. And that concludes my short intro. I'll now hand the time over to Alexander. Over to you.
Thank you very much for the introduction and a very warm welcome. And good afternoon from my side. My name is Alexander Bari and I'm the Managing Director of the IMAA Institute. I'm very pleased that we expect a very high turnout today for this webinar, and I'm gonna briefly introduce the content of today's masterclass and also the speakers, and then we'll hand over to the colleagues as well. We're gonna share the screen now. So what are you going to expect from today's masterclass? So here are our speakers. Nicole from IBF has already mentioned that we are joined by Christopher Kumar, our founder and the president of the IMAA Institute, who is going to share a bit about the institute itself, how we have been established and what we have done so far. Then we're going to join by one of our most seasoned faculty members, Rohit Singh, who is from Xayah Capital, and yeah, one of our, I think, most seasoned, experienced valuation experts as well. So he's going to lead you through the digital fintech space in Southeast Asia during his part of the presentation. And last but not least, we're going to have a bit more insight into the training and M&A trainings provided by IMAA, and also where fundings are available from IBF, and hopefully by the end of this presentation we'll be able to have a lively panel discussion and Q&A, and we invite you to, of course, participate in the Q&A by typing your questions then later on. And so we can have a good discussion. So then I'm going to hand over to the founder of the institute, Professor Christopher Kumar. Thank you very much.
Hello, good afternoon, everybody. So it's a pleasure to be with you today. Just a brief introduction and overview to the institute. We've been around for more than 15 years. I started all this, and We also are deeply embedded in Singapore and Southeast Asia for many years. It's something that's very close to our heart, and the IBF's mission of the ecosystem and our mission as the Institute for Mergers, Acquisitions and Alliances as a global think tank is very much aligned. We've had thousands of participants in our open programs. We do have also a couple of companies that we work with very closely in in-house programs, and all of the faculty that we involve come with hands-on practical experience. So what you see with Rohit and also myself, I've not been sort of on the teaching and university side only in all of my life, but have done deals, and I think that really matters. And sort of we also provide sort of access to materials like an online e-library where we subscribe to the latest valuation M&A books or Harvard Business Publishing and things like this. So we invest a lot of our heart and mind into this, and are obviously accredited and recognized by a lot of credible organizations globally, including IBF, and we're grateful for working together with IBF and also in hosting this webinar. All of our programs are available online, self-paced, so recorded videos where people can do this at their own pace. Virtual Live, sort of something similar but way more interactive than what we do have today, and we're also moving back to on-site trainings despite COVID and other things. So just a quick intro. I'm sure you're really excited in getting going into the FinTech sort of discussion. And when I bridge FinTech and M&A, I think one of the deals that I remember globally very vivid is like eBay acquiring PayPal, and then unwinding this later. So there may be good time for partnering with some organizations, and then letting go later. And I think this is what the whole session is about. How to invest, how to build fintech companies, and probably exit fintech companies. And we'll talk about also a little bit about valuations and things like this. So with this, I would want to hand over to Rohit Singh. Rohit is a dear former colleague and faculty member of the Institute. We work very closely together with on a lot of things. So therefore, I would like to hand over to Rohit.
Thanks, Chris. Hi, guys. For any possible, I can share my screen. Yeah.
Yes, you can share your screen. Yeah.
Yeah. Thanks.
Yes.
So hi, guys. My name is Rohit, and I'm located at Kuala Lumpur. I work for Zaraya Capital, which invests in life sciences technologies globally. And Southeast Asia is one of the areas and sectors, that geographic sector that we closely look at and invest into. So today's session would be mostly focused on the trends of startups in Southeast Asia. And all said and done, it's mostly fintech and diversified financial services, which dominate the startup and unicorn status in Southeast Asia, followed by e-commerce, which supports the fintech space, and e-commerce and logistics. And what we are going to learn today is basically understand the trends which is taking shape in Southeast Asia, the kind of investments happening, what are the kind of valuation at different stages of investments, and last but not the least, valuations of exit, whether the investors are making money by investing in Southeast Asia or not, because that is where the tire hits the road when you see exits. And beyond Southeast Asia, we'll also be looking at the global technology stocks and the valuations and re-ratings which have happened lately because of increase in interest rates in US and the fall in stock markets. So we'll see how these things are related and how Southeast Asian startups in digital space are getting affected and re-rated. So y'all can drop in your questions in the box. Most of the information that we'll be sharing and talking about will be publicly available information with some snippets of discussions which I have had with fellow VCs in the region of what they are seeing and the trends that's happening. Okay. So going ahead. So Southeast Asia now, I understand that most of us are located here, and like we have been experiencing a surge of apps and offerings and services on the digital space by various companies and startups over the last many years. I think for the last 5 years, there has been a surge of digital startups that have happened, and you'll find holdings and advertisements in YouTube and holdings and on the taxi or even in bus services of various apps asking you to download for asking for food delivery or putting your excess surplus into wealth management startups and so on. If we put all these trends into numbers, what we are seeing is that 2020 to 2030 is expected to be the digital decade. The next 10 years is going to be very important for all these startups, with the total digital Southeast Asia internet economy reaching to close to a $1 trillion GMV in value. Not one country is left behind. All the emerging nations, frontier nations, Cambodia, Thailand, Philippines, along with Singapore, Indonesia, Malaysia, everybody is like moving ahead or chugging quite or accelerating, I would say, towards achieving this $1 trillion GMV in Southeast Asian market. If we see the current number of users, internet users, it's around 440 million, and 440 million using internet amounts to a GMV of 174 billion or close to a 200 billion, which is expected to balloon to a $1 trillion economy in next 10 years. If we see individual country-wise, few countries stand out in terms of growth. One being Philippines, then which is expected to grow by 9x, then Vietnam by 11x, followed by Indonesia and Thailand at 5x, and Malaysia and Singapore closely following with 3.5x to what it is currently available. So if you add all these 330, 70, 150, which is the 2030 numbers, they all go up to $1 trillion GMV. Now, what would a 1 trillion GMV in Southeast Asia would look like? So what will happen in next 10 years? So we are already seeing a lot of these happenings, like the e-commerce, which is expected to be a new way of life. 50% of all retail spendings is expected to be online, and it's only 10% today. Online groceries, 1 in 4 grocery dollars are to be spent online. Transportation and food, backed by e-commerce and online groceries, transportation and food would be ballooning up. And it's expected that drones and robotics would also take a special place in the whole ecosystem. We are expecting a lot of global players to come to Southeast Asia and scale up their brand. Health tech would become pretty prominent. So we have Hello Doctor and Doctor Anywhere and multiple startups in the healthcare space already helping the users, helping the patients a lot by teleconsulting and home-based medicine delivery. Digital payments, digital finance, and wealth management and consumer lending is, it's already there now, and it's expected to increase by 40% or 50% by the next 10 years. And beyond Southeast Asia, frontier markets such as Brunei, Laos, Cambodia, and Myanmar are expected to be included in the whole growth of e-commerce in the next 10 years. Now, considering this $1 trillion internet economy, already leaders in digital tech such as Grab and Gojek have already started becoming a super app. And if you see the progress of these major behemoths, like they have been, they started off like 5 to 7 years back, and they have been increasing their presence from not only transportation, but to include lending, payments, food delivery, insurance, hotel ticket booking, health technologies, and so on. And while doing that, they have been acquiring multiple companies and small startups, which is growing. Now, we all know that growing a startup to scalable and profitable level is pretty difficult. And when you're in a digital space, such as payments and so on, companies operate in very thin margin. But these acquisitions, like strategic acquisitions by leaders such as Grab and Gojek, who are consolidating the space, becomes a good exit opportunity for the entrepreneur and the investor who's putting money into such startups. So even with small margins, negative cash flows, companies and investors are exiting at an average $50 to $100 million, giving them 5x to 10x kind of returns. Because of this phenomena, you will find that a lot of new digital payment startups, food delivery startups, transportation, taxi apps, and so on keep on coming up, and they're getting gobbled up by large companies. And on the similar hand, like a lot of companies also are failing on a daily basis and getting closed down. Now, if we look at the overall Southeast Asia from a very top view, we'll find that it has a very similar growth, and just like China, like if we compare 1 to 1, we'll find that Southeast Asia is like where China was 10 years back. So there are various examples to prove that also. For example, if we take food delivery, like Meituan in China, DoorDash in USA, they all started in 2010, 2013. And this particular business model picked up in Southeast Asia with Food Panda, GoFood, GrabFood, all between 2012 to 2018. So the years of best practices to adopt, it took around 5 years compared to China. Coming to e-commerce, logistics, and payments, Bozao in China, Kenino in China, Alipay in China, WeChat Pay in China, all of them started in 2007 to 2004 to 2013. And we have similar startups like NinjaVan and C-Money, GoPay, GrabPay, etc., starting 4 years to 10 years from China. Coming to the online games, again, we see that there is a 5 years gap to adopt the best practices in Southeast Asia. So on average, we are finding 5 to 10 years gap between what China was and what Southeast Asia is expected to be. And when it comes to investments and startups, as we discussed earlier, exit becomes very important because that is where the tire hits the road. And what we find is that this is a China box, and all these blue boxes are companies which have IPO'd and given exit to the initial investors. What we are finding is that similar boxes are getting filled up in Southeast Asia vis-a-vis the IPO market. And again, there is a 10-year gap that we are seeing on the maturity of the startups to reach the IPO stage. For example, which is a large company in Southeast Asia, Singapore-based, whose brand is Shopify, got IPO'd in 2017 compared to Alibaba, which got IPO'd in 2007 in China. So again, there's an average 10-year gap that we are seeing. And we all know where China is in terms of e-commerce and digital tech and FinTech space. Coming to now the recent last year financing in the digital space in Southeast Asia. Despite COVID and things recovering, we found that it was the largest funding recorded over the last many years. Like I think it's last 10 years, in a single year, there was close to $26 billion invested in startups, and 25 new unicorns, like 25 new startups got the unicorn status, compared to 21 unicorns which happened between 2013 and 2020. So in fact, 2021 was one of the best years for Southeast Asia. In 2020 we found, and 2019 we found, the funding had kind of plateaued, and there was also a effect of COVID in 2020. But as things started recovering, we found that more than the investments and funding more than doubled, and large number of companies, around 25 companies, achieved the new unicorn status. And some of the transaction which happened was J&T Express, which is into logistics, then Ninja Van, Mint, which is into payments, Caro, which is into transportation, which is just like Grab. So these companies reached unicorn status. A few more companies like Carsome in Malaysia, even they achieved unicorn status last year. So of the 26 billion, around more than $8 billion was invested in 10 million plus deals. So in one check was more than $10 million. There were also notable IPOs and SPAC exits. So Bukalapak, GoTo, Grab, CTOS were notable exits. Around $5 billion of the $26 billion was invested in FinTech. And similarly, around $5 billion plus was invested in logistics of this 26. So $10 billion was invested in FinTech and logistics together. Now, if we see the spread of money which has been going into, like where have these dollars flown into? We find that most of the dollars have flown into seed stage, Series A, Series B, some in Series C, and very less in the Series D and Series E. Now, how we differentiate between all these series is about the maturity of a company, the number of years the company is existing since its startup. So Series D and Series E, you will find like approximately more than 4 years or 5 years to 7 years is the time when Series D to Series E form. Now, just why is this phenomena there and why does it happen? Globally, it has been found that Series D and Series E is a kind of a death zone for startups. And what happens is when a VC investor invests in the money in the early stages like seed, Series A, Series B, they want to exit within 3 years to 5 years. And the most probable exit is IPO or getting acquired. Now, when a company reaches 5 years plus in its existence and is unable to exit, most of these startups are negative cash flows. If you're not able to exit within 5 years or 5 to 7 years also, it becomes very difficult to exit beyond that. Then you need to become profitable to sustain yourself. There is a deal fatigue among venture capitalists. They don't want to keep on funding a loss-making startup. So that's why in raising a Series D and Series E becomes very tough for startups, not only in Southeast Asia, but this phenomena is very common across the globe. And it's very important that as you reach Series C, Series D and Series E should happen via an IPO. You raise funding and give exit to your investors. If you look at the developed markets versus emerging markets, across the globe, 2021 has been very positive for in the funding zone, and globally there has been a more than 100% increase in funding compared to Southeast Asia, which is around 67%, which has increased. The US showed more than 100% increase, and the emerging markets, India achieved the highest funding in 2021. Most of the investments have gone into technology sector and less in the brick and mortar space. If we see the value or the amount of funding which has gone into Southeast Asia versus China and US, we see there is a gap of $1 billion versus China and approximately $4 billion compared to US. Again, the size of the market is something which matters a lot, which creates these differences. But considering the growth Southeast Asia is seeing in the use of internet and the use of internet services, maybe Southeast Asia would be able to catch up to these differences. So Southeast Asia is already $26 billion funding last year. Now we also looked at how Southeast Asian economy has come up post-COVID, how they have recovered, and what we find that like from 2020 compared to 2020, from 2020 to 2021, emerging market, Southeast Asian countries have like shown a growth which is comparable to the world. Either they are better or at least equal to the world growth. So if you see Malaysia, Indonesia, Vietnam, and Philippines, they have grown faster than the world compared to Singapore and Thailand, which is more or less equal to the global growth. And internet-based services and technology has acted as a part of a great solution to all the COVID-19 restrictions with grocery startups in the grocery and pharmacy, schools, parks, retail, all showing immense growth during the times of COVID. It was kind of a boon for them. So you have these companies such as Happy Fresh, Grab Food, HelloDoc, C, which is Shopify, MTech, OVO, GoPay, Bukalapak, Lazada, all gaining huge traction during the last 2 years. Compared to public transportation and tourism startups, which faced some issues while during the COVID, which is logical because of restrictions and so on. So Traveloka, Red Doors, and Grab Taxi, Gojek, Carsome, these faced some issues and degrowth during the COVID. But as the COVID opened up, funding has happened in Carsome and Red Doors, and Carsome has become a unicorn post the funding. Now, so financial services was the leading sector over the last 2 years with the funding. If you see that like around $4.3 billion was invested in financial services, and of the total funding, around 35% of the total funding in Southeast Asia has gone only to FinTech. And of the number of deals, around 26% of the deals and 35% of the dollar value has gone into FinTech, which is like kind of one of the highest in Southeast Asia over the last few years. And if we compare it globally, we find that it's even higher than US and India, the amount of funding which has gone into financial services. And if you see the number of financial services, the amount of funding has been the highest in emerging markets such as Africa and Latin America, which is very logical considering these places have been left behind for a long time in terms of logistics, e-commerce, FinTech, and so on. And things are picking up pretty fast and in an accelerated way in these emerging economies. Some of the other areas where investments have happened, which are part of FinTech, are payments and diversified financial services. These include investments in VN Life, Momo, Niem, which is into foreign currency transfer and so on, SN Money, Graph Finance, Gcash, and so on, followed by wealth investments in wealth and business lending, such as funding societies, CapBay, ZipMex, StockBit, Ajaya, and so on. Just look at the growth in the funding; it's around more than 700%. Again, some other sectors in digital space and fintech, which is quite popular, is the insurance and banking services such as Igloo and Tonic and so on, which has shown a large number of investments and deal volume increase, consumer lending and data analytics and so on. And what we find that Indonesia and Singapore have the highest number of more than $1 billion or unicorns available, with other countries such as Vietnam, Malaysia, Thailand, Philippines quickly catching up. So some of the well-known names which are in the unicorn, like as we discussed, was Sea, Grab, Bukalapak, Ajaya. You have iFast in Singapore. Vietnam has Momo, VN Life, and so on. And in the $500 to $1 billion, we again have multiple companies. Being from Malaysia, we have seen the growth of CTOS getting IPO'd and giving very good exit to investors in the company. And beyond homegrown startups, we have global companies such as Lazada also occupying a unicorn status at a regional level. Other companies such as Food Panda, Ovo, and so on are quite popular apps that people use. Coming to the valuations and round sizes. So what we find that most of the investments have happened at pre-A level, followed by Series A, Series B, and Series C. As most of the investments from a VC side is in the early stages. Why it's so? It's because if you look at the median valuation, you enter at a pre-A of $6 million average at pre-Series A, and Series A is around $20 million. And as you go up the series, the valuation becomes $60–62 million. Now, please note that most of these startups are loss-making and cash burning. So if you invest at a higher valuation, you need to exit at a higher valuation too to make money. And what we are finding is that the average capital being invested by family offices, individuals, and also venture capitalists at pre-A is around $1 million. At Series A is around $5 million, and B is around $15 million. So if you're investing at Series B, average check size is $15 million, and you're entering at a pre-money valuation of $60 million. So you need to exit at least more than $100 million to boast of a decent return within 3 years. How has been the exits? So exits, what we are seeing is mostly have been into over the last many years have been under trade exits or mergers and acquisitions or secondaries. IPOs have been, which is the gray zone, has been very less. Now, what has happened is in 2021, because of multiple IPOs, as we discussed, like Bukalapak, GoTo, Grab SPAC, and CTOS, the number of IPOs, the deal value of the IPOs have increased, and we have seen a tremendous increase in IPO exits in the year 2021. And that makes 2021 very special for Southeast Asia, because this particular year proves the thesis of investors over the last 10 years that in Southeast Asia, you can invest and exit at a unicorn status from a startup and make money out of it. Now, if you look at the last few years, if you look at the pink zone, which is the secondaries, a lot of funding in startups happened in 2010. Now, if you look at a venture capital, their life is 8 + 1 + 1, 10 years, or 10 + 1 + 1, 12 years. So average 10 years is the life of a fund. And the fund would like to exit before that and return the money. That's the mandate. They have to return the money to the LPs by the 10th year average. So suppose somebody would have invested in 2010. By 2017 and 2018, they're not getting exit. So what happens? So either they sell and trade exit at a low value or exit via secondaries. So you see a lot of secondaries happening in 2017. So my guess is many Southeast Asian investors were not able to make money here because you sell secondaries, or you sell secondhand your product. You always sell at a discount, right? So if your price per share is $1, you would be selling at 70 cents or 50 cents to $1, or at a discount, not making money. And that actually makes 2021 very special because the number of secondaries, the amount is very low, dominated by IPOs and SPACs, followed by trade exits. Now, this is the first year which has shown a bit of a reversal in exits, and that's very positive for Southeast Asia. So we are going maybe the China way, as we discussed. We are 10 years behind. So Southeast Asian startups have started showing maturity. So Grab, Bukalapak, Gojek, Tokopedia all achieved exits in 2021. And we see that the top 10% achieved an exit of $500 million, more than $500 million. And the top 25% achieved an exit of $80 million. Not a great exit value for the top 25%. But if we see top 10%, which was again very low over the last many years, it has suddenly increased. Again, it is skewed towards some IPOs such as GoTo, Bukalapak, CTOS, Grab, which was a SPAC, all at very high valuations, like more than $10 billion valuation. So that may have shifted the median a bit. But again, this is the best year that we have seen over so many years, and we expect that this trend will keep on increasing. What will be most notable to witness is this top 25%, which is around $80 million exit value, going up beyond 100 or maybe $150 million in the next couple of years. Remember, Series B, we are entering at $60 million. So an $80 million exit is not a noteworthy exit. It should go beyond it, and that is what is expected. If we look at the exits in the $20 to $50 million, that has been a huge number compared to all the other spaces, such as more than $100 million, very few deals. Only 5 deals have happened, where versus $20 to $50 million exit has been 11 deals and so on. So again, this is a very small snapshot of various transactions that have happened. What we are trying to show is a trend that even though you have some great companies here, the average exit or the volume of exits are higher in the $20 to $50 million range. So as an investor, as a VC investor, I would like to invest in seed or pre-series A, which is around $6 million to $10 million, and get an exit maybe at a $50 million at a 5x. So that would be my strategy. And I may not be investing in Series D and Series E. So that makes Series D and Series E or companies or startups in the 5th year to 7th year zone very difficult to survive if they are not becoming profitable. Most of the exits which we see have happened in the FinTech, retail, and entertainment. This is 2021. So your maroon, green, and red are financial services, retail, and entertainment. And no doubt about it that financial services dominates the Southeast Asian investment space. Malaysia and Philippines recorded the best exit to investment ratio. So amount of investment was suppose like $720 million. Invested was $500 million and you exited at $700 million in Malaysia, giving a 1.4x exit to investment ratio, followed by Philippines. Exits via M&A, again, payments dominated over the last many years, like over the last 3 years. Payments and financial services space have been the zone of acquisition, with Gojek and Grab dominating the acquisitions. And what we see is that over the last, like 2016, 2017, and 2018 were the zones of great exits for multiple digital payments and wealth management startups. What I can try to make out is maybe there are a lot of funds who started investing in 2008 or in 2010, and they want to exit by the 7th year or 8th year. And that is why we find a huge number of exits. I would be doubtful if I'm a bit doubtful if they are all profitable exits for investors, but exit. And these companies got acquired by large startups such as Grab and Gojek. If you see the IPO, the number of IPOs have kept on fluctuating over the last many years in Southeast Asia, but we have seen a growth in IPO as we discussed in 2021, and is expected to go up much more than one of the largest markets in the world, India. Exits via SPAC, which is another form of IPO, is also increasingly becoming popular. So Grab, one of the largest startups in Southeast Asia, went for a NASDAQ SPAC. Currently, average exit is around 8 years, but it's expected to reduce to 6 years over the next few years. Now, if we look at the global tech stocks, what we find that over the last few months, like 3 to 4 months, public markets have re-rated. So this is a S&P 500, which has moved from 18 times EV by EBITDA to around 15 times EV by EBITDA, and maybe it is reducing more. It is expected to remain in this particular zone over the next 3 to 6 months, and the average EV by EBITDA over the last 10 years have been around 11x. What this has led to is that the tech stocks, now you will be knowing that tech stocks occupy around 30% of the S&P 500, and tech stocks have re-rated pretty high. So from a 42x EV by EBITDA, it has fallen down to around 22x now, and it's still quite in a fluctuating zone. Every day you'll find plus 3% going up, the next day it goes down to minus 3%. So this is followed by like re-rating of stocks such as Zoom by 50%, Netflix by 40%, Meta by 40%, Nvidia by 26%, Tesla by 26%, and so on. And this phenomena is common across the board over the last since the last 6 months. So whether it's internet-related companies, software, fintech, semiconductor, hardware, it has shown a huge decline, 20% to 40%, and so on. What this has led to is that emerging or disruptive tech, the valuation and the share prices have come down to traditional indices such as Berkshire Hathaway Index. So it has been a very slow and steady growth. And if you take ARK Innovation ETF Index, which grew exponentially, has fallen down and merged with Berkshire Hathaway Index over the last 1.5 years or 2 years. The market is penalizing companies which are growing pretty fast, but with low profitability, and they have been heavily repriced. So if you compare an EBITDA margin of 1% for a tech stock, they have repriced with minus 65%, like that has fallen down by minus 65%, versus a company whose EBITDA margin is 23%. The re-rating is only 34% compared to 65%, almost half of it. So it has become very important that startups are not loss-making and they are profitable. And there won't be any takers or investors for companies in the 5th year or 7th year of existence are not making money. Now, this trend has also translated in the private market sentiment. And as we have been saying, that Series D to Series E has become a huge issue for a lot of startups to invest or to raise funding. And we have seen SoftBank, Vision Fund, Sequoia Capital, Tiger Capital, all of them making public statements that they may not be investing, or they may be stopping investing in that particular zone and focusing only on early stages at very low valuations so that they can have alpha during an exit. So if you look at Series E to Series E valuations, private market valuations, it is around $700 million to $2 billion. This is a global valuation zone for startups. So with the recent pullback, it'll become very difficult for companies in this particular zone to raise funds with such kind of valuations. So even the private market valuations would get re-rated and repriced in the coming days. Some of the companies also went through SPAC, and what we have seen is, along with the public markets, even the SPAC market with SPAC indices have fallen down pretty badly. So this is the pink one, which is a SPAC index. It has underperformed S&P 500 over the last 2 years. It went up pretty high, but then it has re-rated and gone down. And most of this SPAC consists of disruptive and new technology companies, new world technology companies, including Grab, which is there. So 90% of the SPAC are trading below the IPO price. Average return has been minus 40%. Only 7% are trading in the positive territory, and only 0.5% of the SPAC deals have beaten the S&P 500. Now, what this has resulted is that Grab listed at more than $50 billion, but it has over the last many months fallen down to around $11 billion. Bukalapak listed in Indonesia at $8 billion, but it has fallen down to $550 million. We have GoTo and Tokopedia, which merged together to form Gojek, and Tokopedia merged to form GoTo. It listed, and it has been able to hold on to its valuation. It was listed at more than $30 billion, but it's trading at pretty decent $26 billion market cap. We have a prolific company in Southeast Asia, which is Sea, Shopify being one of the brands. They IPO'd in October 2017 in New York Stock Exchange, and it went up from, you can see, like, it went up from $17 billion to $117 billion, or created an additional $100 billion value over December 19 to December 22. So in 1 year, it created an alpha value of $100 billion for its investors. Because of the global re-rating in stocks, it has now fallen down. So it, even though it was listed at $5 billion, it's at $40 billion. It went up to $117 billion. And currently it's at around $40 billion. So this was an overview of FinTech and digital space in Southeast Asia. I'll just touch upon certain aspects what we teach in IMAA. In IMAA, we make the candidates aware of the basics of how to value a company. What is the concept of pre-money valuation, post-money valuation? What is the concept of primary investment? What is the concept of secondary investment, and so on? So that when you are doing your own startup, or even you're approached by your friends to invest in their startups, you are well aware of what is the valuation you're investing in, and how much stake you are getting by investing X amount of dollars. We also talk about how valuation buildup happens in startups. What is the meaning of pre-money valuation? What is premium that is attached in every series? So Series A, Series B, there is a premium attached to it. Where does it come from? How your stake, suppose you have made an angel investment and you have a 33% stake, how it goes down to 22% and 17%, or in other words, how you will get diluted with every round of investment, and should you make a follow-on investment in a good company, at what valuation should it be made. So basically a bridge of an understanding of the valuation bridge of how things are moving and how to calculate a startup valuation from the scratch. We also discussed certain other structures of investing in a startup, which would consist of convertible financing, where you invest in a startup without a valuation. And after a few years, when the startup is able to raise funding from an institutional fund and is valued at X million dollars, you will get at your money will get converted to shares at a discount. So how to skin this cat, how to invest in this particular structure, and what things to consider, IMAA and the faculty members would guide you in understanding of this. In general, what are the key private equity and venture capital terms that one should be aware of? How deal structuring happens? What are the kind of securities given? Whether dividends are attached to the security or not? What kind of liquidation preferences, participating returns that you can negotiate for? What are the voting rights? What are the anti-dilution rights that you get as a startup investor? There would be drag along and tag along also attached. So what are these things? So what are option pool? What are warrants? What are the maths around it? Because startup investment is, though it looks easy, but when you get down into maths and understanding your rights as an investor, it becomes a little complex. And we'll be then mapping this understanding to larger transactions in private equity space of how to structure the deals and what to negotiate and what not to. There are multiple other key VC and PE terms, such as right of first refusal, pay to play, and so on, which we cover during our sessions in the IMAA lectures. So again, these are some of the various rights given to either preferred shares or common shares. So these are some of the areas that we touch upon while when you join us in the paid sessions, in the full sessions, where we take you through all these terms and understanding around it. So thanks, guys. I'll hand it over to Chris now and IMAA team to take it further.
Thank you so much. I guess also in the Q&A, we will come to the question you posted already. So feel free to keep on posting, so then in Q&A, we can discuss the questions you posted here. I'll hand over to Fayani to guide us through, programs and funding available in Singapore. Thank you.
Thank you, Prof. And thank you, Rohit, for the insightful sharing. Hi, everyone. Good afternoon. So my name is Priyani, and I'm from the Singapore IMAA office. And hopefully you all have a very insightful informations and also the updates on the FinTech valuations and also what is the current situations right now. So before we go to the Q&A sessions, allow me to share on what you just learn for the past 50 minutes. It's on the financial modeling and business valuation course. So this course is available. And also, if you are working in the financial institutions or FinTech companies, you are eligible to apply for the IBF FTS, stands for Financial Training Schemes. And also for the funding wise, please wait for the updates from IBF tomorrow or within a couple of days, because there'll be some changes in the FTS funding as well. So please take note of the dates as well. It's going to be on 29th of August to 1st of September 2022. And the time-wise, it's from 7 p.m. to 10:15 p.m. Singapore time. And if you have any queries about evaluation training and also related statistics, please scan the QR code and it will lead to my email, and we'll be happy to share with you on the informations and also on what, if you'd like to ask more about these programs. All right, so next I have another slides. Oops, yeah. So on the capacity building for M&A, we have 5 certificates programs. So 2 certificates programs on international mergers and acquisitions expert and also certified post-merger integration specialist are eligible for IBF STS funding, which stands for Standard Training Schemes. So these 2 certificates are available if you are Singaporean or Singapore PR physically located in Singapore and you're eligible for this funding. 90% for Singaporean age 40 years old and above. And if you sign up now before 30th of June, which is tomorrow, for those who are below 39 years old and also Singapore PR, you are still eligible for 80%. However, the completion deadline will be until 30th of September 2022. However, if you sign up from 1st of July 2022, then your funding will drop from 80% to 70%. And on the right side, we have 3 other certificates programs, which is legal M&A, M&A professionals, and also HR M&A specialist. So please do not hesitate to contact us if you are interested to take some of the modules. All right, and next slide. Let me go. So these are our upcoming virtual and also on-site trainings available for SDS IBF funding schemes. So currently we are running for the IMAA and also the CPMI certificates virtual trainings. And if you miss out for this 27 June, you can still register for 18th of July. And the time-wise, it's from 3 p.m. to 6 p.m. Singapore time. And this is eligible for the standard trading schemes funding by IBF. And for those who are interested to attend our on-site trainings, finally, after 2 years or, close to 3 years from COVID time, we finally run back our on-site training again in Singapore. Please take note of the date. It starts from the 12th of September until 16th of September. All right, so it's Monday to Friday, time-wise from 9 a.m. to 5 p.m. Singapore time. And SDS funding schemes is also available. Okay, so next one, let me share. Oh, sorry, the course-wise, it's going to be in the 4 days format, not on the 5 days. And for those who are in the valuations work or already somehow doing the valuations and learn on valuations during your bachelor or your master time, definitely you are not foreign to the name of Professor Aswath Damodaran. He is the valuation guru, and we are very honored and happy to have him to train us for the valuations with Damodaran virtual live training on September 2022. So please take note of the time as well, and also the date. It will start on 19th of September. The time-wise will be starting from 8 a.m. morning to 11:15 a.m. Singapore time. The reason why we start from 8 a.m. because it's going to be a virtual live with Professor Damodaran in US. Okay, so please feel free to approach us as well if you would like to find out more on the valuation training with Professor Aswath Damodaran. Lastly, this is the very common FAQs for IBF funding and also our IMAA certificate programs. So for example, if you would like to go for the IBF STS funding, do you have to register with the full cost amount? So the answer is no, you are not required to pay the full cost amount. You're only paying the co-payment amount, which is either 10% or 20% or 30% starting from 1st of July for those who are age group 39 years old and below, and also Singapore PR. second questions, and how do you register for the accredited IMAA programs? So we need you to help us to fill up the registration forms and also to do the online registrations. So feel free to approach our Singapore team, my colleague Karina, and also myself, Friani. And I will share with you the contact details after these slides. Third questions, what happens if you decide to enroll in Q2, or I will say it's at Q3 this year? So likewise, if you're going to join in Q3, which is starting from 1st of July, if your age group below 40 years old or Singapore PR, then your funding will drop from 80% to 70%. However, no funding changes for Singaporean age group 40 years old and above. Okay, last questions. So when is the on-site training in Singapore will take place? It will take place on the 12th to 16th of September 2022. So we are very excited to welcome you also in our on-site trainings, and we will also fly our international trainers to come to Singapore. And also, in due to the pandemic restrictions, we will also abide to the, the updates from the governments as well. So if should there be any announcement, we will be sharing with you in the promptly manners. So lastly, Karina, my colleague in Singapore, feel free to contact her, and also myself. Our email address and our mobile phone are stated on the slides. So that's all for my sharing part, and I will give back the sessions to Professor Christopher Kumar and also Rohit to answer your Q&A. Thank you. Over to you, Prof. and Rohit.
Thank you so much, Feriani. And yeah, Rohit, let's look at the questions in the chat. Layoffs was the first one.
Yeah, so I think the first two questions, like layoffs and about Grab and Gojek, I think they are very common, similar answers. So, as we discussed, with re-ratings happening of the valuation and inability of startups to raise funding after the fifth year, in the fifth year to seventh year zone, the party has to end someday, right? And party generally ends in during such kind of market movements. And there have been open letters by Y Combinators, Tiger Global, Sequoia Capital, and so on, where they have warned entrepreneurs that the winter is coming, and it's going to be very difficult for entrepreneurs of cash guzzling businesses to raise required funding. So sooner or later, such companies will have to find a way to profitability. Until and unless they do it, they will be getting into cost-cutting measures. And cost-cutting measures would involve, the best way to cut the cost is lay off people, because that's generally a chunk of the cost to the sales, which we find in startups. And it's unfortunate, but like from a career opportunity also, in the next coming months, whenever you get a chance to join a new tech startup, you need to check with them the amount of funding they have and how many years or months those fundings will last, and also ability to raise funding from startup. In general, like sustaining only on investor money is not the right way to go for an employee when he thinks about the career move. So yeah, so this party will get over, like is getting over actually for multiple startups. But when you talk about unicorns and companies such as Grab, my expectation is that they will be able to sustain themselves, because it is the largest in Southeast Asia and has been able to launch multiple services. And if you look at both Gojek, which is GoTo now, and Grab Food has become profitable, and even GoTo Food should be profitable. I'm not fully aware of the margins, So there are services within the large group which are positive now. And you all must have seen or witnessed, like when you book a Grab cab also, the prices are pretty high. It's not a low amount of teaser rates that we used to find a couple of years back. So they know that these companies or large companies know that they are becoming kind of a monopolistic in nature, and they will be stretching consumers to pay more, and people are paying more because of good services and so on. So I think now I haven't analyzed Grab as such, but I expect them to, like, that should be the whole case of like becoming profitable in the next few years. Yep.
This is right. I think there's some, I mean, some business models were clearly not sustainable, right? You see some, promises made to customers which are unrealistic. So to do like, fast delivery within kind of seconds or minutes, right? This is not really sustainable. And, I think with these investments, actually, some investors actually pull funds, which we've seen in, neweconomy.com bubble in the year 2000 as well, right? The party was over, hand back the cash. So some of them may come to a full stop if the business model is totally unviable. And then again, like there's some startups that take a number of years, to become profitable, and they are provided, the time to do so.
Yep. Thanks. Next question is, what angel investing platform do you recommend? Well, I can name you certain venture or angel platforms. Recommendation, I don't want to recommend as good or bad. It's something which you have to take a view on. So one particular platform is very popular in Southeast Asia is Fundnel, Fundnel, Fundnel. Then you can also look at something called Angel's Den. That'll give you a global startup kind of thing. Then there are multiple startup angel platforms in Europe and US. One of them being Leap Funder, and so on. But you have to be a bit careful when you're investing in angels, because all of these angel platforms collect money together and in a holding company, that the holding company invests. Like various startups, even angel platforms is a startup. I'm not sure what happens if this startup wounds up, angel platform startup wounds up. But the question is, the market, NASDAQ and S&P is so down. Why do you want to take a risk in a private firm, right? Why don't you invest in public markets? Again, it's a view, and there are multiple, if you do a Google, there are multiple such angel platforms. And sooner or later, some of your friends will approach you to invest in their startups. And that is where I think you have to take things seriously, because you know the guys, you know the entrepreneur. And the question would be, at what value or valuation you enter and what terms you are able to extract. Next question is, what is your view of valuations versus PE multiples, especially in the context of looking at average of not 10 years, but in the climate of elevated inflation? Well, as we saw in the slides also, with elevated inflation, what happens is that when your inflation goes up, now to counter the inflation effect, the interest rate goes up, or banks increase the interest rate, right? So when you increase the interest rate, just think from a DCF angle, discounted cash flow angle. DCF, the interest rate comes down as a discounting, right? So if your denominator is increasing, the valuation reduces. So valuation of all the tech startups have re-rated or repriced or reduced. So one of the best indicators is the ARC Innovation Index Fund. Now, it's very difficult to talk about P by E or EV by EBITDA for startups, because they don't have this. They're all negative in numbers. But if you look at the EV by sales, what we have found that EV by sales is approximately 10 to 15x for Series A kind of companies, and it goes up to around 20x for Series B. I think this will come towards the 10x zone, not more than that, as we move towards a highly inflationary environment where valuations will be lower. But again, EV by sales and so on is not the right parameter, because even the sales for pre-Series A is very small, right? It's not showing the growth. So valuations of startups will always be played in a zone of numbers. Series A being 10 to 15 to 10 to 20 million dollars, and an inflationary zone maybe reduce a bit. Series B being $60 million, maybe come down to $40 million and so on in a high inflationary environment. And this is for Southeast Asia. Yep. So these were some of the questions. I think I'm able to satisfy you with the answers.
All right. If there are no further questions for Rohit and Christopher, we can end the session here. Just checking if Riani and Alexander have any other things to share. All good? Okay, awesome. All right. So thanks. Yes. Go ahead.
Oh, sorry. We have another questions by in the questions box. So can you tell us about audited FS of these startups, and does auditors insist on getting a qualified opinion? So maybe Rohit or Prof would you like to answer this question?
I'll take this. Now, what happens is that most of these startups, like good startups, like they are funded by large, popular investment houses like institutionals, and all these institutions, like they insist that the startup is audited by good auditors, big fours. That is what we do, like when we invest. So all the bells and whistles attached to a proper audit is done. In the audit report, every time we invest and every time we see in any company, going concern is an issue, which is always mentioned that, they may not be left with enough cash in the 6th month next year, right? But that is how startups run, right? Follow-on fundings happen in the last moment. And that is the risk of investing in a startup as an investor, and we do accept it. What we care as an investor is everything is done in propriety. The board is doing its job pretty well. We are okay to lose money in a startup due to business issues. The company was not able to raise funding. It was in a business which cannot be scaled up, or the market is not supporting the idea. What we don't want the money to be lost in is fraud. We don't want money to be lost because the entrepreneur embezzled it. So that would be a huge problem for an investor. So that is where good auditors such as Big Four, seemingly good auditors, perception-wise, come into picture, and we try to hire them. Now you should look at certain startups in Southeast Asia which have faced heat of the auditors while they are going for listing in NASDAQ and so on. You can Google and find information. And SPACs and IPOs have been delayed for Southeast Asian startups because they're not conforming to the audit and governance standards required by the US. So yes, issues do happen, but as I said, investors are very careful. and they put their board representatives who are responsible for hiring the right auditors and getting the right audit. A compensation committee is there, a separate compensation committee, a separate hiring committee is there to do the checks and balances of how the CEO is performing and what kind of decisions the CEO is making and so on.
I think that's also one of the changes that comes with, accepting investors, outside investors, or going public, that this is not just about hiring an auditor or investment banking firm. This is about fundamental transformation and governance, information sharing, decision-making sharing, which for some founders or some businesses is hard to achieve, and they underestimate the effort that has to go into this. All right, if there's no further questions, then yeah, I think we hand back to Nicole.
All right, thank you very much, Christopher, Rosie, Alexander, and Farani for the excellent presentation and all the useful insights you've shared. We've now come to the end of today's session. Thank you once again for joining us. You may scan the following QR code to stay connected with us via our Telegram group, our website, or sign up for updates on future events. Thank you very much and see you again soon.
Thank you.
Thank you, everyone. Thank
Bye.
you.